In the next 90 days, the two most powerful AI companies ever built are going public. One is the name everyone knows, 900 million users, the product that made the world stop and stare. The other is the one the world's largest corporations quietly depend on, the one that just filed for its IPO 2 days ago, the one racing toward a $1 trillion valuation, yes, and catching up fast. Together, they represent the single largest double IPO event in the history of technology, nearly $2 trillion of AI hitting the public market at the same time. And most of the people about to invest have no idea what they're actually buying. And this is the breakdown they don't want retail investors to see. To understand why this double IPO matters, you need to understand how both of these companies were born from the same moment of idealism and the same moment of betrayal. OpenAI was founded in 2015. Nonprofit, no shareholders, no quarterly targets. The mission was pure: build AI that benefits all of humanity, not just the company that owns it. Among the founding team, a VP of research named Dario Amodei and his sister Daniela, who ran operations. They believed in the mission completely. Then Microsoft came in with billions, and the nonprofit structure bent to accommodate them. The mission shifted, the culture shifted, and in 2021, Dario Amodei made a decision. He walked out. He took his sister Daniela, he took 7 other senior OpenAI researchers, and together they built a new company from scratch with one foundational principle hardwired into its DNA: safety first, always. They called it Anthropic. What happened next is one of the most remarkable parallel stories in the history of Silicon Valley. Two companies, same roots, same researchers, completely different philosophies, racing each other to the future, and now both arriving at the same destination, the public stock market. But what they look like under the hood could not be more different. Let's get into the numbers, because this is where the story goes from interesting to absolutely critical for anyone putting money into either of these companies. OpenAI, $25 billion in annualized revenue. 900 million weekly users on ChatGPT. Private valuation, $852 billion. That sounds extraordinary, and it is. But here is the number that changes everything. OpenAI is projected to lose $14 billion this year alone. It loses $1.22 for every single dollar it earns. Internal projections show cumulative losses hitting $44 billion between 2023 and 2028. Profitability is not expected until 2029, at the earliest. That is not a startup growing fast. That is a structural problem. Now look at Anthropic. At the end of 2025, Anthropic's annualized revenue was $9 billion. By February 2026, $14 billion. March, $19 billion. April, $30 billion. May 2026, $45 billion. That is not a typo. Anthropic went from $9 billion to $45 billion in annualized revenue in under 6 months. Salesforce, one of the greatest enterprise software companies in history, took 20 years to reach $30 billion. Anthropic did it in under 3 years from a standing start. And who is driving that revenue? Not consumers. Over 300,000 businesses are paying for Claude. More than 1,000 of them spend over $1 million a year. 8 of the Fortune 10, the 10 largest companies on Earth, are Anthropic customers. Netflix, Spotify, KPMG, Salesforce. These aren't experiments. These are production workloads that companies cannot afford to switch off. That is the difference between OpenAI and Anthropic in one sentence. OpenAI has the users. Anthropic has the business lock-in. Now here's the part that Wall Street analysts bury in footnotes. And it is the most important context for understanding what you are actually buying into. OpenAI's investors include Amazon at $50 billion, NVIDIA at $30 billion, SoftBank at $30 billion. Total latest round, $122 billion at an $852 billion valuation. Jensen Huang of NVIDIA publicly called OpenAI the single most strategically important customer NVIDIA has ever served. These are not passive financial bets. These are infrastructure partnerships worth hundreds of billions. Anthropic's investors, Google, with roughly 14% of the company, the largest outside stake. Amazon, with an $8 billion commitment and a pledge of up to $40 billion more from Google in April. Sequoia Capital is on both cap tables, a firm with a long-standing rule against funding direct competitors. They broke it for this. Let that land for a moment. Amazon is one of the biggest backers of OpenAI. Amazon is also one of the biggest backers of Anthropic. Google holds 14% of Anthropic. These same companies are OpenAI's biggest cloud partners. The world's most powerful tech companies are not picking a winner. They are funding both horses in the same race, and they will profit regardless of who crosses the finish line first. When you buy either IPO, you're sitting at a table where the house already has every seat covered. Here is what the roadshows won't say out loud, the things buried in footnotes, the structural risks every retail investor needs to understand before September or October. On OpenAI, the company was born as a nonprofit, a vehicle for public good, not shareholder returns. In 2019, it restructured into a capped profit model to raise capital. Now it is restructuring again into a fully for-profit entity to go public. Every restructuring diluted the original mission, and with each one, Sam Altman's personal equity stake grew. That is not an accusation. That is a fact from the filings. Public investors should know who benefits most when this company goes public. OpenAI has also locked in $600 billion in future data center spending commitments. $600 billion. CFO Sarah Fryer privately told company leadership she worries revenue may not grow fast enough to cover those contracts. Board members have reportedly grown more aggressive in questioning why Altman continues adding compute capacity even as revenue falls short of internal targets. And only 5.5% of ChatGPT's 900 million users pay for a subscription. The product that made OpenAI famous is, for 94.5% of its users, completely free. That is not a business model. That is an audience waiting to be monetized. And the monetization OpenAI chose: ads. In early 2026, the company that once called advertising a last resort began testing ads in its free tier. Draw your own conclusions about what that signals about the underlying economics. On Anthropic, the revenue growth is real. The enterprise customers are real, but Anthropic's revenue is reported on a gross basis, counting total end customer spend, including what flows through Amazon and Google Cloud as top-line revenue. Those partner payouts are booked as expenses. That is a legitimate accounting method. It is also one that makes revenue look larger relative to companies that report on a net basis. Investors should understand the difference before comparing Anthropic's $45 billion figure to peers. There is also an antitrust shadow over both of Anthropic's largest investors. Google and Amazon are under active regulatory scrutiny in the United States and Europe. If either is forced to divest holdings as part of a regulatory settlement, Anthropic's cap table changes overnight. That risk is not priced in anywhere. On both, compute costs are the ceiling no one wants to talk about. Every query on ChatGPT costs money. Every Claude API call costs money. The GPUs running these models never stop. OpenAI's CEO once admitted compute costs are, quote, eye-watering, until the cost of running these models drops faster than the price they can charge for them. Both companies are operating on investor oxygen, not business oxygen. The kind of analysis you just heard costs institutional investors tens of thousands of dollars a year. Here, it costs you nothing. If you find this valuable, subscribe, because the OpenAI Roadshow starts in weeks. We are going to be here for every move. So, what do you actually do with all of this? OpenAI is the brand play. If you believe that AI becomes the operating system of modern life, and that ChatGPT becomes what Google search was to the internet, then OpenAI is that bet. The losses are real, the restructuring is messy, but the moat is 900 million users who open that app as a reflex. That is not nothing. That is habit, and habit is the most durable asset in technology. Anthropic is the infrastructure play. The enterprise lock-in is deep. 8 of the Fortune 10 do not switch vendors lightly. A company whose revenue grows 1,400% in 6 months is either doing something genuinely extraordinary or is experiencing a surge that will plateau. The answer to that question will become visible in the first 2 quarters after it goes public. Watch the churn rate. Watch whether the number of million-dollar customers keeps doubling. That is your real signal. Here is something that happened while most people were distracted by the SpaceX IPO. On Forge Global, the platform where pre-IPO shares trade, Anthropic quietly overtook OpenAI. For the first time ever, Anthropic's implied valuation exceeded OpenAI's. The market is not waiting for the IPO to make its call. The smartest retail strategy for both of these listings is the same. Do not chase the day one pop. The institutional investors who got allocations at the offering price will sell into your enthusiasm. Let the stock settle. Watch the first quarterly earnings, and then decide with numbers, not narratives. Because both of these companies are extraordinary, and both of them are expensive. The difference between a great company and a great investment is the price you pay, and when you pay it. OpenAI, Anthropic, September, October. This is the fall that changes everything in the public markets. Subscribe, because the next breakdown drops before the first prospectus goes live.